You're here because, well, you want to get smarter about investing, right? Faster. And without wading through loads of jargon. We totally get that.
Yeah, information overload is real.
So today we're doing a deep dive into something really, really fundamental for protecting your money and helping it grow. We're talking about drawdowns.
Exactly. We're going to unpack what these dips in your portfolio actually mean. And, importantly, we'll look at how automated trading systems, expert advisors or EAs can be a serious help in managing them.
We'll be using some solid info to guide us through this.
Right.
So first off, what is a drawdown? Put simply, it's just a measure of how much your investment account drops from its highest point, its peak, down to its lowest point afterwards.
Think of it like the tide going out after it's reached high tide. The drawdown measures how far out it goes. It's a crucial risk measure.
Absolutely vital. Ignoring it is, well, risky. It tells you about the potential bumps you might hit.
Forgetting drawdowns is like admiring a skyscraper but not checking the foundations. You need to know how sturdy things are when the market shakes.
So our mission today is pretty clear. By the end of this, you'll really understand what drawdowns are, why they matter so much, and how these EAs, these automated systems, can actually be sophisticated tools to help you manage that risk.
Yeah, it's about getting you that key info efficiently, a shortcut to understanding this crucial concept.
Okay, let's make it concrete. Give us an example of a drawdown in action.
Sure. Let's say your account grows nicely, hits a peak of $10,000, then the market turns a bit and it drops down to $8,000. Pretty common scenario.
Right, so what's the drawdown there?
Well, that's a $2,000 drop from the $10,000 peak, so it's a 20% drawdown. Straightforward.
Okay, 20%. And the information we're looking at suggests there are different ways to track these, different types of drawdown metrics.
That's right. We need to look beyond just that one number. The first big one is maximum drawdown, often just called max DD.
Max DD, got it. What is it?
It's simply the largest single drop, percentage-wise, that your portfolio has experienced from a peak down to a subsequent low point over whatever time period you're looking at. It's the deepest valley you've hit.
The absolute worst dip recorded in that period. Okay,
Yeah.
what's next?
Then there's relative drawdown. Now, this is closely related. While max DD might tell you the biggest dollar amount lost, relative drawdown always expresses that loss as a percentage of the peak value it fell from.
So back to our example, $10,000 down to $8,000. The $2,000 drop relative to the $10,000 peak, that gets us the 20%. That's the relative drawdown.
Precisely. It keeps things in perspective. And there's one more key one, drawdown duration.
Duration, so how long it lasts.
Exactly. It measures the time it takes from when your account hits that low point, that trough, all the way until it recovers and gets back to the previous peak value. It's not just how deep the hole is, but how long it takes to climb out.
Right, because a quick dip in recovery feels very different from being underwater for months, even if the percentage drop was the same.
Totally different experience for an investor.
So these three max DD, relative drawdown, and duration, they really give you a much more realistic view of the risk involved in a strategy, don't they? Much more than just looking at profits.
Oh, definitely. Profit and loss alone don't tell the whole story about the journey. These metrics show you the potential turbulence.
Makes you think, doesn't it? What metrics are you currently focusing on when you think about risk in your own portfolio? Something to consider.
Okay, so we know what drawdowns are now. Let's shift gears and talk about how technology, specifically these expert advisors or EAs, can help us manage them.
Yeah, these trading robots. What's the advantage?
Well, a big part of it is discipline. EAs run on programmed logic. They don't get scared, they don't get greedy, they just follow the rules they're given. That's a huge edge over human emotions sometimes.
Right. Fear and greed can really mess up trading decisions. Holding losers too long, cutting winners too short. We've all heard it. So how specifically can a well-designed EA protect capital from drawdowns?
Okay, one of the most basic but powerful tools is automated stop loss and take profit settings, SL and TP.
Explain those quickly.
Sure. A stop loss is a preset price level where the EA automatically closes a losing trade. It cuts the loss before it gets too big. A take profit does the opposite. It locks in profits on a winning trade once it hits a certain target.
So it prevents one bad trade from really damaging your overall account balance, like automatic breaks on each trade.
Exactly. That's a good way to put it. Then some EAs have more advanced features, like equity-based risk control.
Equity-based, so looking at the whole account, not just one trade.
Precisely. These systems monitor your total account equity, the overall value. If that equity drops below a certain level that you define, the EA can trigger broader actions.
Like what kind of actions?
It could be programmed to, say, stop opening any new trades for a while, or it might automatically reduce the size of future trades. In some cases, it could even close all open positions to prevent further losses during a sharp downturn. It's like a master control for the whole account.
Wow, okay. So that's like a portfolio-level safety net, a circuit breaker for your whole strategy. That sounds pretty robust.
It can be, yeah. Another tool is dynamic position sizing.
Dynamic sizing, meaning the trade size changes.
Yes, automatically. The EA adjusts how much capital it risks on each trade based on market conditions, usually volatility. So if the market gets really choppy and unpredictable...
They trade smaller.
Exactly. It reduces the position size to limit the potential damage if a trade goes wrong. But if the market seems more stable and conditions look favorable, it might cautiously increase the size, within limits you set, of course, to potentially capture more profit.
That makes sense. Adapting to the environment to manage risk. Sounds smart.
It's about being flexible but disciplined. And then you have the really cutting-edge stuff. Adaptive algorithms.
Adaptive algorithms. What makes them different?
These are more sophisticated EAs that try to actively recognize the current market conditions or regime. They analyze patterns, volatility, maybe other factors to figure out if the environment is becoming too risky or unpredictable for their core strategy.
And if they sense danger?
They can adapt. They might switch to a more conservative approach, trade less frequently, or even just pause trading completely until things look safer. Think of it like an airplane's autopilot sensing turbulence and adjusting for a smoother ride, or even suggesting waiting it out.
Okay, so EAs definitely offer some powerful tools for drawdown management. But it's not just set it and forget it, is it? Human oversight must still be important.
Oh, absolutely crucial. Automation is a tool, not a replacement for smart portfolio management. There are still best practices you need to follow.
Right, let's talk about those. First one seems key. Diversification.
Yeah.
Don't put all your eggs in one EA basket, so to speak.
Exactly. Relying on just one EA or one market pair, one strategy type, it's risky. What if that specific strategy hits a rough patch or that market goes sideways?
Your whole portfolio suffers.
Precisely. But if you diversify, maybe use a few different EAs with different logic, trading different currency pairs or even asset classes, you spread the risk. If one part is struggling, hopefully another part is doing okay. It smooths out the ride. Like having a balanced team rather than just one star player. Makes you think, how diversified is your approach right now?
Good question to ask yourself.
Okay, next practice. Review the max drawdown history. Why is looking back so important here?
Well, past performance never guarantees future results. We all know that. But looking at the historical maximum drawdown of a strategy tells you how it actually behaved during past market stress.
It shows you the worst case scenario it encountered before.
Yes. If an EA historically had, say, a 30% max drawdown, you need to be mentally prepared and financially able to potentially endure something similar again. It helps you set realistic expectations and gauge if you can stomach that kind of volatility.
Knowing the potential depth of the fall helps you brace for it. Makes sense. Another recommendation, always use a demo account first. Why is this test drive so vital with EAs and drawdowns? It's absolutely essential. Running an EA on a demo account uses virtual money, but in the live market. You see exactly how it performs, how it enters and exits trades, and crucially, how it handles losing streaks and drawdowns in real time without risking your actual capital.
So you get a feel for its personality, its risk profile, before committing real money.
Exactly. You see if its behavior matches your own tolerance for risk. It's like watching a recording of potential future events.
A smart precaution. And the last point here, set realistic recovery expectations. What's the thinking behind this?
It comes back to that drawdown duration metric we talked about. Look at the history. How long did it typically take the strategy to recover from its previous drawdowns? Knowing this helps you stay patient.
So you don't panic and jump ship during a normal drawdown.
Right. Every strategy has drawdowns. Understanding the typical recovery time based on past data helps you avoid emotional decisions, like abandoning a perfectly good strategy just because it's temporarily down. Patience is key.
Okay, so let's wrap this up a bit. The bottom line seems to be that drawdowns are just part of trading. You can't avoid them entirely.
No, they're inherent to markets. But the key takeaway is they can be managed, effectively managed.
With the right understanding, the right tools like these EAs we've discussed, and critically the right discipline.
Exactly. It's about combining smart automation with smart oversight to minimize that downside risk while still aiming for growth.
And the goal, really, is to find or build systems that trade intelligently, protect your capital as a priority, and aim for sustainable, long-term results. It's not about get rich quick, it's about steady progress.
That's the sustainable path, which really leads back to you, the listener. How does this conversation, this deeper dive into drawdowns, change how you view risk in your own portfolio?
Yeah, what practical steps could you maybe take now to feel better prepared for those inevitable market swings?
Those are the really important questions to reflect on.
Definitely. And if you want to keep exploring these ideas, find more resources on managing trading risk and using EAs, you can check out the YouTube channel at Faida Ventures. It's a good place to continue learning.
Stay informed, stay protected. Ultimately, successful investing isn't just about chasing returns, it's maybe even more about managing the risks along the way. And understanding drawdowns, that's fundamental to managing risks well.